Hi, thank you for having me today, and thank you for allowing Barriga Consulting Associates to evaluate Porter Products options and come to the best business decision for your company. Just to review the facts that you provided to us originally, Porter Products is purchasing vitamins from a foreign company located in Canada. They are invoicing you in Canadian dollars, and your concern is surrounding hedging exposure to foreign currency exchange risk, which is totally understandable. We appreciate that you entrusted our firm to do this research for you. And if you have a minute, I'd like to go over the results. So we essentially researched two options. The first option regarding foreign currency forward contracts. And there are several benefits to entering into a forward contract. The first would be locking in a discounted spot rate, which the spot rate is the current rate. So you'd be locking in a discounted rate of the Canadian dollar. This will be used for a future payment date. So if you locked it in today and said you wanted to use this in 90 days, the rate you locked in today would be what you would use in 90 days. This allows you to protect yourselves against future fluctuation of the Canadian dollar. This contract is most frequently used to hedge certain foreign currency cash flows. The potential disadvantage to this is that the locked-in rate will hold regardless of whether the future increases or decreases. So you could wind up with a loss, and this honestly could be an unlimited loss. So another benefit is that this is free and matches your firm's exposure hedging your foreign currency exchange risk. However, if it's used with uncertain cash flows, you could be exposing yourself to more foreign exchange risk. So you want to make sure that if you do exercise this option, that you are exercising it in relation to certain foreign currency cash flows. The second option that we did research was a foreign exchange option contract. This contract would allow Porter access to a pre-agreed exchange rate on a predetermined date. So you would say in 90 days, we want to purchase a Canadian dollar at this rate. And that would be locked in for you. At that date, when that 90 days hits, you can either buy or sell the Canadian dollar depending on the spot rate at that time. This type of contract is most frequently used to hedge uncertain foreign cash flows. So if we weren't sure how the dollar was going to perform, if it was, fluctuating out of the norm, then we would want to use this. The cost of this contract is up to the option premium. So based on the graph in this report that was provided to you, we are showing that as of March 2019, the Canadian dollar is selling at 74 cents US dollars. So for 74 cents US, you are able to purchase one Canadian dollar. Based on that and the fact that even though in February we did see a 2-cent increase in the value of the US dollar, we still believe it would be a benefit for Porter to enter into a foreign currency forward contract for hedging. Entering into a 3-month hedging agreement would allow Porter to lock in the current exchange rate of 74 cents to one Canadian dollar. This would protect you from the trending rise in currency exchange rate. And as mentioned in our initial meeting, if you have any more questions or concerns, please feel free to let us know. We can do additional research, but at this time, we feel like we have done an exhaustive report for you, and we are very confident in the results that we found. So we are definitely recommending that you move forward with a foreign currency forward contract. Thank you for your time. Thank you for your business. And we'll talk later.